Hope you guys are enjoying your weekend. Let's begin. Today's topic is entry and exit signals in the market. So basically, we are 8.87% away from the all-time high. We just took support from 100 EMA here. If you take Nifty 50 past year returns, it is 0.95%. So we are close to 1% returns in the entire year. The market has been bad since past 1.5 years, and good signs of recovery are coming. So let's dive into the topic. There are basically 16 signals, 16 sensors, 16 signals for market entry and exit. When to enter the market, when to exit the market, these 16 signals tell us. So few of them are liquidity flow, momentum, daily market turnover, relative strength, VIX, etc. etc. So this is the current state of market, all these numbers. Let's go to signal 1. Signal 1 is broad market health, which states how many stocks are above 200 DMA. So the percentage of stocks above 200 DMA. Basically, we have a charting screener which shows how many percentage of stocks are above 200 DMA. Currently, it is 41.72%. I'll give these links to you guys. So if the percentage of stocks is above 70%, then the bull market is running. And if it is between 50 to 70%, it is equilibrium state and neutral position. Less than 30 is panic, like we saw a few days ago. Less than 20 is pure fear. So let's go to signal 2, which is macro valuation gravity, which in short terms is market cap to GDP ratio. So the market cap of the Indian stock market right now is 4.65 trillion. So divide that by GDP of our country, which is 4.65 divided by 4.5. It's 1.03, 103%. So if it is somewhere around 100 to 120%, it is overvalued. Right now we are still in overvalued zone. If it is under 75%, it is undervalued. Fair value is between 75 to 100, and greater than 120 is danger zone. This happened only once during 2020 COVID. So this is one of the indicator to enter or exit the market depending on the valuation of the overall Indian market. Let's go to signal 3, which is earning premium, or also we can also tell this as Nifty PE ratio. Nifty PE is basically, if it is less than 16, it is deep value, 16 to 20 is fair value, 20 to 24 is elevated, greater than 24 is expensive, greater than 28 is historical danger. Currently Nifty PE is somewhere around 21.4. We surpassed the golden buy zone. Somewhere around 19.6 was the golden buy zone. We surpassed that. So 20 to 24 is slightly expensive since we are recovering. The PE of Nifty is also recovering. So anything below 20 is blind buy. 20 to 24 is cautious, and 24 greater than 24 is when you exit. Let's go to signal 4, which is small cap versus large cap. There is a trading view thing that we can do, which is CNX small cap divided by Nifty 50, which gives, So if right now it is 0.7, which is 70%. If it is close to 1, if less than 1 means small caps are still lagging behind large cap. Greater than 1 is the huge divergence, which symbolizes the exit signal, which we saw in 2024. And right now small caps are lagging behind large caps because money is flowing through large caps now. Then it will enter mid caps, then it will go to small caps. So 0.7 is basically lagging indicator, which is early bull sign, which is where we enter small caps and we exit when it crosses 1.03 or something. This is how we see the signal 4. Next, IPO heat index. Basically, if we get 1 or 2 IPOs per month, then it is moderate subscription. Money is flowing, and 3 to 5 is warming, high subscriptions. 6 plus is greed. 5 to 100 is euphoria, which we saw recently in 2025. So there is a way to find this. We have a market Chittorgarh where we see how many IPOs are being listed and how many IPOs in SME segment also we can see. Right now we have moderate number of IPOs coming up, so we are in safe zone. We are somewhere in between warming and greed zone because market is recovering and slowly we can see IPOs coming up. Signal 6 is institutional ammunition, which states how much cash is mutual funds holding. Basically, what I track is I track Parag Parik because they're the first one to go to cash positions. If the mutual fund cash levels is greater than 6 to 8%, then fund managers are seeing the market to be cautious. If it is in between 3 to 5%, then normal deployment. And if it is less than 2%, it is fully deployed. So this data we can see in AMFI. So basically AMFI provides a monthly note where we can see where the money is going in which mutual funds. See, this is how you can read how much money is going to which mutual funds. Technical extremes and fear mechanics. We check this by two factors. One is how much far is Nifty from 200 DMA and India VIX. Let's see how far is Nifty from 200 DMA. So right now we are here. 200 DMA is the blue line. We are 2.51% away from 200 DMA, which was much farther here at this point, which was close to 11.81% at this point. 15% above is overheated, which is pure buy zone, value zone. 5 to 15% is healthy bull trend. Basically, this is above. This is plus. Basically, I'm talking about plus 15% from above 200 DMA, which means overheated. That is sign of exit. 5 to 5% is healthy bull. 0 to 5% is equilibrium, which is quite normal. Accumulation zone. 5 to 15% minus is what we have, which is pullback, which is accumulation opportunity. 15% below is crisis zone, which is pure golden buy zone. Next we come to India VIX. Current India's VIX is 17.2%. If it is less than 12, then extreme complacency. Smart money is trimming, which means fear is less and bull run is there. 12 to 18 is normal zone, which we are currently right now. Trend following works. Basically, if the trend is downwards, then downward works, and if the trend is upwards, then upward works. 18 to 25 is anxiety zone. This is where we exercise caution, and any sign of reversal, we exit here. Greater than 25 is fear spike, which is excellent buy zone. Greater than 35 is when you sell all your lands and put your money in equity. Next is, see, this is extreme panic zone. This is huge buy zone, and extreme complacency is when peak bull run is there, and that's when you exit. We'll come to PCR later. Next, how much money is FII net inflow is coming? If they are buying for 20 consecutive sessions, then it's a bull confirmation zone. If they are selling for 20 sessions, then it's a distribution zone and you see a huge fall. Sustained exit needs to happen. So this data we can track in Grow, where each day how much FII is buying, how much FII is selling, how much DI is buying, how much DI is selling. Basically, we have a continuous exit here of FIIs in the past. Right now they started buying. Let's see if they continuously buy or not. Next is advanced decline ratio. So advanced decline ratio states how many stocks are in green and how many stocks are in red. Basically, we track this with in money control. If you can see, advanced decline ratio is 39 divided by 11. For Nifty Bank, it's 14 divided by 0. Okay, 0 we can't divide, but this is advanced, this is decline. So this is how we track for example, in Nifty 500, 399 advance and 99 decline. This is how we track. In BSE, you can check Sensex 24 and 6. This is how we track advance decline ratio. So basically what it states is, if the advance decline ratio is greater than 1.5, you divide that, and if the number comes greater than 1.5, for example, let's see for Nifty 500, 399 divided by 99 is obviously greater than 1.5, which is healthy bull participation. And if it is less than 1, then the divergence is happening, and it signals a market fall. That's when you exit. And in the bottom, when it is close to 0, is when you buy. Now next is 52-week high versus low of BSE 500. If 200 stocks are at 52-week high and less than 20 are at lows, it means it is a strong bull sign and we can invest confidently. If it is in between 100 to 200 stocks which are at high, which is moderately bull. We are close to 100, which is moderately bull. You can track this in charting every day, each and every day, how many stocks are in high and how many stocks are at 52-week lows. So earlier this number was 149, 300, 293, etc. in the past. If 100 stocks are at 52-week low, then it's a bear market. If more than 200 are there, then it's a bottoming process. That's a huge value buy. Next is liquidity stress, which means basically ETFs are sold at a discount compared to NAV. So if ETFs are at 0 to 0.5 discount, then percent discount than the actual NAV, then it is considered a normal sign. If it is between 1 to 2%, then it is mild stress and panic selling is happening. 3 to 5% is forced selling, and arbitrage by more than 5 is large discount, which happened in 2020. How to track this? See, so the market price versus the NAV. Right now NAV is 23, market price is 24, so it is trading at premium. But here NAV is 14.74 and market price is 14.65, which means this is available at a discount. If more ETFs are trading at premium, then it's a bull market. If more ETFs are trading at a discount, then it's a bear market. Credit spread. Credit spread basically states if the corporate bond yields, for example, is 7% yield, and if the government security bond yields are yielding at 5%, BPS comes around 200. So we have to track the yield percentage of bonds. So if the BPS comes around less than 100 BPS, then money is flowing freely, which means equity is bullish here. 100 to 150 means it's normal, neutral, standard institutional risk pricing. 150 to 200 is we have to reduce the equity exposure. If it is greater than 200, then credit crunch and exit equities. So bonds signal when to exit and when to enter a stock market. So how to track this? Trading view indicator, which is credit spread regime, which we can use on chat. For example, if you take Nifty 50, you have this. This was a sign of exit. Basically, anything above 2 here is a sign of exit. Around April 2025 was a sign of exit. Somewhere here, 22 was a sign of exit. May 22 was a sign of exit. So this indicator right now is at 0.66, which means 60 BPS. So we are in the safe zone. Signal 14, which is how much percentage is promoter pledging. If promoter pledge percentage declining, then it's a bullish sign. If it is stable, then it's a neutral. If it is rising, then it's a red flag. And if it's rising and the market is falling, then it's a pure danger thing. How to track this? We have a 5 paisa website where we can track increasing or decreasing stakes in BSE 500, Nifty, and all. You can track this data here. SIP versus lump sum ratio. If this ratio is steady, then disciplined investment is happening. If lump sum is greater than SIP, then FOMO is picking up. It is a late cycle signal. if lump sum spikes after a big rally, then it's a retail are there and FII and DI are not there. If SIP flows are declining and lump sum is also declining, then retail is exiting, which signals a possible bottom of the market. So this is tracked again with the AMFI monthly node, where we can check where the money is flowing, in which mutual funds. So mutual funds also give a signal to enter or exit the market. Next and last one is PCR. PCR is put to call ratio. How many puts are there and how many calls are there in the market. This we can track in Upstocks. PCR. So PCR acts on the expiry dates, weekly expiry dates. So right now the PCR is 1.05. So if it is greater than 1.3, then puts are there, and which means people are shorting the market and it's a contrarian buy signal. If it is 0.8 to 1.2, then trend is continuing and it is balanced. And if it's less than 0.5, then it's a bull run. This is where sharp and sudden corrections can happen, because you don't know how option buyers and sellers will react to. Market overheating is a sign of exit, and this is sign of entry. In 2020, basically VIX spiked to 85 plus, which is maximum fear, and signal 1, less than 20% stocks are above 200 DMA. Signal 7, Nifty is 35% below 200 DMA, the distance from Nifty price to the 200 DMA. Signal 12 is all ETFs were trading at discount. So this was a pure value buy zone. And in 2021, Nifty P exceeded 40. Signal 5, these IPOs came. Signal 15, retail lump sum inflows drastically outperformed disciplined SIPs. Signal 9, FIS silently distributed, triggering subsequent 15% correction. This was a sign of exit in this euphoria. So these are the signals, and if you don't want to, check everything, going through each and everything, I made one prompt for you guys. So what you have to do is go to this, input the date here. Let's change the date here and put that in Claude and see the magic happening. Let's wait for it. So I hope you guys like this. I hope you understand when to enter and when to exit the market. The devil is in the details. You just need to find the signals. You just need to be aware of what's happening around you rather than just being a price investor. Let it load. I already made it yesterday, which looks like this. It took all the signals here, and it tracks how many bullish signals are there, how many neutral signals are there, how many bearish signals are there out of 16 signals. And it gives an action framework, which is cautious accumulation zone for long-term investors, for medium-term, and for active traders. And basically it has a composite score between 0 to 100, which states the way to exit, way to exercise caution, way to cautiously accumulate, way to accumulate. So basically from 86 it's slowly going down, and when it comes to the caution and in between strong exit, from 0 to 26 is a sign of exit that we have to exercise. See here, I don't know why 50. So it is not a sure shot sign, but it's a, you can use this to get a estimate if you don't want to research everything going through each and every website. I'll give you the link to the all the websites, and also I'll give the link to the prompt. Hope you guys like this. Thank you.